We're going to be talking to Cody Ye. We're going to be talking about stock options and stocks in general.
There's a lot of real estate investors are either stuck or either they are looking for another way to diversify because they're questionable about where the Canadian real estate is going, and they don't see a lot of opportunity besides going to Alberta or going to the States. And they're really looking at, say, real estate is such a capital heavy investment, and it's very labor heavy and a lot of things to look at as well. Is there a better way that I don't have to deal with contractor? I don't have to deal with, tenants, toilets, accountant, all that stuff. Can it just be myself and the phone and swiping right on my phone anywhere in the world to make a double-digit return like what we're doing with hundreds of my clients, right? If you're someone who's smarter on the contrarian side, understand what's really going on and take advantage of the opportunity, we can potentially, right, continue to beat the market. The only biggest fear, I'm full transparent, the biggest fear is when the
Welcome back to the Canadian Real Estate Channel. I'm Adam J.D. Martin, your host, and today we're going to have something a little bit different. We're going to be talking to Cody Ye, who likes to say yay to fire. And I think that's a really appropriate introduction for Cody on this channel, because today we're going to be talking about stock options and stocks in general. This is not something that we usually talk about on this channel, mostly because I have no idea what I'm talking about when we talk about stocks and other options and things like that. But I figured now would be a really good time to have some diversification on the channel, because people have been sitting on the sidelines for a long time with real estate investing, been holding on to capital. We've been watching interest rates. There's been steep declines and drops in housing prices since COVID happened. And now is a really interesting time where I think we can open up our scope and just really start understanding what other options are available to us. So Cody, why don't you tell us a little bit about who you are, where you come from, what's your experience with real estate investing, because I understand you are an investor there as well. And then let's chat about stock options.
Cool, yeah. So thanks, Adam. So my name is Cody Ye, and I came to Canada as an immigrant at the age of 18, and I finished my engineering degree at University of Toronto, and I go ahead and work for Honda, the car company, for 6 years as a project manager. And over those 6 years, I managed about $100 million in terms of industrial and process improvement projects. And that's really what sets me up for the real estate investing. So I bought my first property, right? That was, at that time, I didn't have a lot of money. So I chip in $37,000 buying a property with my mom, before the joint venture was really known, right? We bought a bungalow in Toronto, and that, we bought it for $520,000. And that property right now was been approached by a developer to give it to them at $4 million. So that was definitely a moonshot, right? That's crazy. That was nearby the LRT, and I don't count that as my own equity, right? And because that's really my mom's on title, I'm just a silent partner on it, right? That's where my first taste of real estate, and not every project is like that, right? And I move on to buy my first home nearby Honda, and then I bought more duplexes conversion, and we built a garden suites in the back. And now all my money is going to US for diversification, because I don't really like what I'm seeing in Canada. I still have a lot of hope, right? I'm being on the contrary side, but I still want to diversify, right? So that's my real estate side of things. But in the meantime of all this, I started investing in stocks in 2011, right? As a second-year engineering student. And I originally started investing just like everyone else in boring stocks like the TD Bank stocks, RBC, and all that stuff. Start getting into mutual funds, get into ETFs. And at what point between 2015 to 2017, I was actually day trading. At that time, I had a coach who was 2 years younger than me, right? Right now I'm 33, right? It was 2 years younger than me, and she was already managing $50 million, right? So I was learning from her, but I soon realized that day trading is not scalable in terms of the market absorption rate, because of this, the how to get in and get out is harder with bigger money. So, and then also it's very hard on my body because I was working a full-time job in the daytime and I was day trading at night in the Asian market. So that's where there's a 12-hour difference, right? And that's where, fast forward to sort of 2019, that's when, I was promoted to a mid management and having a low six-figure salary, and I sold one of my properties and profit $500,000. I put it into my account, right? And using our said and done strategy, that's what we have been stabilizing over the years. That's where we sell options on the S&P 500, right? Selling options, receiving premium. That's when I brought that account from $500,000 to 1.6 million as of today. So that's kind of, if you annual compound, that's about 20 to 25%. The years that are a bit higher, there's years that are a bit lower, but that's kind of like, nothing too crazy, but still a very good double-digit return. And that's why it got me to be a guest speaker on TD Banks, and then there's more like NASDAQ, Tasty Trades, and more platform that want me to be their guest speaker to talk about it. And the reason why I mentioned that is because there's a lot of real estate investors are either stuck, right, or either they are looking for another way to diversify because they're questionable about where the Canadian real estate is going, and they don't see a lot of opportunity besides going to Alberta or going to the States. And they're really looking at, say, real estate is such a capital heavy investment, and it's very labor heavy and a lot of things to look at as well. And they were asking me like, Cody, is there a better way that I don't have to deal with contractor, I don't have to deal with tenants, toilets, accountant, all that stuff? Can it just be myself and the phone and swiping right on my phone anywhere in the world to make a double-digit return like what we're doing with hundreds of my clients, right? So that's a short intro to you.
Yeah, that's actually a fantastic intro, and it is really it's really great, and it's really exciting for the people watching the channel. I'm sure that you're also a real estate investor, because I think it takes a lot of time and experience to really understand the pain of how capital intensive and how labor intensive real estate investing actually is. And I know that there's not one person watching this channel that's done real estate investing for more than a couple of years there's not one person that would say that it's not capital intensive or it's not labor intensive. Like, the reality is it takes a ton of work, it takes a ton of time, and you are very geographically limited, I would say, in how to invest intelligently when it comes to real estate. I know people often ask, how can I diversify in terms of into different market or a different strategy of investing with real estate? And I find it's really difficult to give good advice on how you can invest hours and hours and hours away in a real estate market that you have no idea about. You have no understanding of it. And I think that's where I initially was intrigued by stocks and things like stocks when I was younger. And I was thinking, it's amazing that all this information is published about these companies, right? They have financial documents that get published all of the time. They're required by law to make sure that those are, they should at least be accurate and be a good representation of what's going on inside the company. And it doesn't take that long to really understand sort of the different measurements as to how a stock is performing or a company is performing. And I think I really like that about stock investing, but I would love for you to explain for the people watching, like, what really is an option, right? Because you mentioned a few different, like, what I'll just call buzzwords there, right? So you've said options, you've said ETF, you've said mutual fund. There's different words that you're using that already I know somebody's going to watch this video and be like, what actually is an ETF, or what is a stock option? So I'd love to start with the idea of, like, I know you mentioned you sell options on the S&P 500.
S&P, correct.
Right?
Correct.
So
yeah.
What does that mean to you?
Yeah. So for people who just have some stocks, can I just put it there over the years that grow, or maybe the company have some matching RSP, they can choose a segregated funds that doesn't really get you anywhere from 2 to 7% per year return, right? So this is where when a lot of my clients, when they come to me, they want to look for ways to have a better return and have more control. And what a lot of times right now with your RSP from the companies, or even just a lot of people get afraid of getting into stock market because they feel like it's so out of reach. They heard their uncle say that it's high risk, it's gambling. One day it goes up, one day it comes down. And that's where over the years, I found that even Warren Buffett said that it's really, really hard to pick good stocks, right? And then, just a little bit of teaser for our next video. I'm going to be showing you guys the top 20 companies in 1989 and fast forward to that to 2021 and see how many of those top 20 companies are still in the top 20. That's 30-year time span, right? So without giving out too much information on that, it's what we realize is that it's very hard to pick individual stocks and win over the long term. That's why a lot of people gear towards mutual fund, like a basket of stocks that the fund managers supposedly know what they're doing, put together. But the problem with that is a mutual fund charge a very high MER, which is a management expense ratio, anywhere from 1 to 3% of it, right? So that means every year, regardless of making money or not, the manager is taking their cut on it. And then over the years, when you compound that, it's very, very significantly reducing your return. And then that's mutual fund, right? Then now the more newer instrument that come out is called ETF. It's basically similar as mutual fund, but it has a small differences. But the main difference is that everyone wants a lower management ratio because people nowadays are smarter now. They know that if you take some part of my money over the years, it could be a huge difference between 1 million or $500,000, right? So that's kind of ETF, right? But summing this all together, why we sell options on the S&P 500 is because S&P 500 technically is the best 500 company in North America or in the world right now, right? There could be a lot of tech stocks like Apple, Nvidia, Google, and all the names, and also stocks that you don't really hear every day, but has been doing really well because of the criteria to get into the S&P 500 is that every, the consecutive 2 quarters has to be making money. The company has to be this size. Basically, they do a lot of vetting for you. And then over the last 90 years, S&P 500 has been going up, averaging 8 to 10% per year over the last 90 years, right? So that's why Warren Buffett said, if I cannot find a successor for Berkshire Hathaway, I'd rather just leave 90% of money in the S&P 500. So banking on that, knowing that if it ever drop, it will come back up. That was proven in COVID, proven in 2021, 2008, 2000, every single crash throughout the history. Knowing that, with a peace of mind, as long as we're bullish on the US economy will continue to grow and stay competitive, people are using US dollar, right? That is one of the safest vehicle we use as a vehicle. So we don't have to pick individual stocks. Like you said, study all the financial statements, who's your CEO and all that good stuff, right? So that's more of like why we pick S&P 500. But I want to take a pause before I move on to like, what's the difference between stocks and stock option, just in case you have any question, right?
Yeah, no, for sure. I completely understand the need to stay away from an individual stock and the benefits I can see very clearly of having like a general bet that the top 500 companies will continue to do better than almost any individual stock, right? Because individual stocks are subject to like the news of the day, like what the CEO tweeted and like all sorts of issues like that. And I think we've seen issues like that. And Matt Matt McKeever started this channel years ago,
Yeah.
and he has a really interesting experience with the company that he worked in being in big pharma. And Hillary Clinton sent out a tweet that like tanked the entire industry, right? Like it totally bombed like a ton of stocks. And all of a sudden, like their company went from like, doing incredibly well to just like in the shitter overnight. And I think like that's something that people, like you said, like your uncle, or you hear that from friends or family, like it could be a gamble or it's kind of scary or you don't really have a lot of control. So I think you've made a great point here that by investing actually in the 500, like top 500 companies, you have a real advantage over picking any individual stock. So I'm fully on board with that. I think like for sure, I would love to hear as we go into like what is an option. That's certainly one question I have. Another question I just have on my mind now is like, I know, and you've just said that like the S&P 500, it's generally speaking going to come up maybe 8-10% a year. And we've just been talking about how you got returns in like the double digits, like up in the 20s. So I'd love, as we enter that conversation about like what is an option, I'm hoping too we can uncover like what allowed you to essentially double the return that it's doing naturally? And how repeatable is that? And I know that's going to be a question that comes up in our comments, and I love those types of questions. So yeah, let's jump right into that. I'd love to understand, like, what is it, first of all, and then second of all, how do I control it? And third, how can we repeat it?
Yeah, very good question. Let's go for the first question first, and we'll unpeel the onion kind of thing. So what is stock option? Right now that we decide, it's kind of like now we decide what to invest in. What are we gonna be doing options on, which is the S&P 500, not individual stocks. We understand the pros and cons of that. We want less volatility. We want to make sure the stock is there, not don't just tank because of a tweak, because a tweak cannot really tank a market. It will tank individual stocks or whole sector of stocks, but not the entire S&P 500. Unless you're Joe Appel and say that I gotta increase the interest rate by 2% tomorrow, then that might tank the whole market.
That'll do it.
Yeah, but normally it doesn't happen like that, right? So now we understand stocks is like buying, holding, waiting for it to go up. Maybe there's some dividend, right? Dividends kind of like what the when you put money in the bank pay you an interest, right? That's kind of like, hey, you put your money in the company rewards you as a shareholders, give you some profit sharing. That's kind of say, hope you keep the money here, okay? Good job, profit, shareholder, right? So now we move into stock option. What is stock option? Stock option is what they call a derivative market. That's a really fancy work of saying, you know what, this underlying stock could be individual stocks like Apple, or it could be like S&P 500, but we can actually buy and sell contract on that. Now, a good way of me explaining what option is using real estate term is buying an option, or not really a real estate term. Buying an option is kind of like going to buy a lottery ticket. The number, in order to make money, the number has to be right, and the time that the number comes out has to be right. That's a major difference between stocks and option. Option, there's the time, and then there's a price. Just like the lottery, there's a time and there's a number. Okay, now whereas our strategy mostly is on selling options. Now, what does that mean, selling options? We are technically the insurance broker. What do we mean by that? Right? Like, Adam, do you pay any auto insurance? Do you pay any home insurance on a monthly basis? Exactly. And then the amount that you pay, do you call that a premium that you pay every month? Now, in terms of the premium, whether you make a claim or not, did you get back the premium? Exactly. So that goes to the insurance company, right? And now by selling options on S&P 500, we're technically the insurance broker for the S&P 500. We basically agree to say buy S&P 500 the shares, not say if it goes down. And in return, we get paid a premium, like how you're paying your insurance company. So now we're the insurance company. We're getting paid a premium. Whether the S&P goes up, S&P stays the same, or go down, we keep our premium, and that's our cash flow, right? And then you guys, Adam, your audience might be asking, so Cody, what's a catch? It sounds so good. It sounds too good to be true, right? The catch is that there's obligation. Just like when the insurance companies sell insurance, there's an obligation they have to fill. If it meets certain criteria, they have to, do something about it. They're obligated to fulfill some responsibility. And in our case, is that if S&P 500 get to a certain point, if it dropped lower, right? We agreed to buy S&P 500 shares at a lower price than the market value. We get paid a premium. Whether or not the S&P 500, wherever it moves, we're keeping it. But if it goes below a certain price, we have to buy it at the expiration date. So that is the most simple way, maybe not so much in real estate terms, but I'm using just everyday life lottery ticket, and then, kind of like the insurance broker to explain that term. I hope it kind of is clear as mud for you.
Yeah, no, I think that generally makes sense, especially when you explain it like auto insurance, where essentially, like, if something happens, like, there is an obligation actually for them to pay those costs, right? And they're essentially taking a bet that, like, most days that you drive, you're not going to get into a car accident, right? Like you drive all the time, but you very rarely wreck your car. So I guess from that context, then that kind of flows nicely into my second question of like, so now I understand what it is. The next best question for me then as a real estate investor, because most real estate investors, I think we can agree, get into real estate investing for two reasons, right? Number one being leverage, because you have access to like 1 to 5 typically.
Mm-hmm.
Leverage, or sorry, like 5 to 1, depending on how you want to look at it. And then there's the element of control, right? There's a real tangible hard asset. I can go in there, I can change out the kitchens, bathroom, landscaping, lighting, and paint and flooring. And I know all of a sudden I've raised the value of this asset. It's very unlikely, unless I've done my homework poorly, that the building's going to be worth less than what I put in. So that brings me to the question there of control, right? So if we're taking bets, as you said, similar to a lottery style, like what are our control measures here? And like, how do I make sure that as I'm taking these bets in order to get these premiums, I don't end up like getting into a car wreck every time? You know what I mean? Because like if the insurance company got into a car crash every day, they'd really quickly run out of their premiums to fund it, right? So how do we go about controlling that as the investor ourselves?
Yeah, that's such a great question. How do you go about control that? And then what's the liquidity, sort of say,
Sure.
right? What's, for say for the stock option. And that goes back to our previous notion, is that why we pick S&P 500, right?
Yep.
If we go and agree to buy a stock, and that stock have a tweak that come out tomorrow, and now an X that come out tomorrow drop to 0, no matter how much premium we get paid, we're still going to lose a lot of money, right? So that's why we focus on S&P 500, which has been historically going up 8 to 10% per year for the last 90 years. So we take that underlying asset risk, individual stock risk away first. That's the first thing. So assuming if it keep doing the same thing, U.S. economy continue to do well, and technically is not even an economy doing well, if the government continue to print money, the stock market will go up in general, because people just have to park the money somewhere. Otherwise, they're just losing it to inflation. So if that assumption is still correct, the S&P 500 will continue to go up, right? And very likely will continue to go up. So in that case, if we already agree on no individual stock risk, S&P 500 will continue to go up, or at least stay the same, will not be going to 0. Then what is the risk of us owning S&P 500? At the current price, what now you can buy at a lower price by buying an off-market deal with it, right? Yes, you can't really artificially put on paint, door, trim to make it look better and push up the value, but you know that historically has been going up, and now you can getting paid to own something at a cheaper price. So getting paid a premium for you to own S&P 500 at a cheaper price than the market value. So inherently, there's some buffer that's put in. You have some inherent value, inherent equity in it, right? You get paid to further lower that, right? So that's kind of like the idea of it. And then, there's a part, of course, you can't control will be, Cody, where the market is going. Can the market stay flat for the next, 3 to 5 years? Of course it can. And we can continue to sell options on it to earn premium. They'll say, okay, now I own it. Now I sell options to agree to sell it at a higher price. If it never reached there, I just keep collecting premium, right? So that kind of solved the problem of, hey, what's the underlying asset risk? What's your control? There's less control, but Historica has been doing well, continue to print money. And also in terms of liquidity, it's a lot better than real estate, right? I'm looking at selling a few properties, and I'm looking at the capital gain tax, looking at the realtor's fee, I'm looking at the lawyer's fee, right? So unless there's a big enough spread, that's why everyone only look at selling a property in 5 years. Now with the high interest rate and things going upside down, maybe people are looking at 10 years, at least holding, right? But for our strategy, the turnover could be anywhere between 5 days to 45 days. That means that if you get paid that, your obligation is done in 45 days. Then you can take away that money and do something else, or rinse and repeat, right? And then you're only on your phone. You don't have to deal with so many other variables that can go wrong. You don't have to have so many things align so that you make money, right? And there's less things and more control and more liquidity. You can just swipe right You can get the money out. I can have my money out, transfer back to my bank account in 2 days, right? So that's kind of like the major difference between real estate and stocks. It could be good, it could be bad too, right? Some people just like, I never look at it. That's why I make a lot of money in real estate. Really just put it in, never look at it. Yeah, if you do the same thing with S&P 500, arguably you will make more money because there's a lot less overhead costs of property management, maintenance, and all that stuff. So when people factor it all in, right, and the return is actually very, very similar now, even with leverage, right? So it's just for the last 20 years, Canadian real estate has been going up like crazy. Everyone thought is like everyone's genius, right? But if it start going like the 2 to 5% per year, then the return after subtracting all the overhead costs is actually very comparable now, right? If that makes sense.
That's it. You raise a great point there, and I think that's something we often talk about in the channel too. Is like you really for real estate need to have time in the market, and I think that's where maybe there's a competitive or at least a comparative advantage to investing in something more liquid, because with real estate, I guess in a similar fashion to how you've talked about the S&P 500, like you can almost guarantee it will continue to go up as a whole, right? Like real estate, generally speaking, again, because it's also subject to inflationary environments, like as long as they print more money, the banks have more money to lend. And generally speaking, that type of inflation trickles down everywhere. And so with real estate, the longer you're in the market, the more likely it is that you will actually enjoy the benefits of that inflation as well, right? If you stay in a market for 10, 20 years in real estate, more than likely, if it's like at least a reasonable city center, like it's got a real population around it, you probably saw a big increase in value, at least 5% per year, almost anywhere in Canada. And so that's where I think there's a very comparable statement there to be had. But with real estate, it really matters. Like it's usually longer times where you have to look at, like 5-10 years for sure, you can almost guarantee you're up, right? Now you can subtract all your property management, you can subtract all the capital expenditures that you had to do, you can subtract like all the actual real inflationary costs too, because like inflation doesn't just target your sales price, it also targets the cost to operate the building, right? So all your gas got more expensive, all your water got more expensive, all of your hydro got more expensive, like literally everything got more expensive as you went as well. So I can see how there's a lot of parallels here. And what I like about what you're talking about is it's a much shorter timeline. Like there's almost nothing you can do in real estate in 5 days. You could attempt to do some kind of like double close situation or something like that, but it realistically isn't going to happen in 5 days. Like maybe if you're a wholesaler, you could sell a contract in 5 days, but that's a totally different strategy than investing in a real asset that you can hold for a long time and essentially expect that it will go up. So I love those parallels there. So I guess that brings me to my next question, really, of like, how then can we leverage these options in order to get greater returns than just holding the actual S&P 500 itself, right? And I know you've said the word cash flow, which this audience loves. We love cash flow. So I would love an idea too of like what type of investment gets me what cash flow could I expect from about roughly what type of investment? And for like, just before we get into any issues here, like these are all just like figurative numbers. We're not going to quote any real returns because like, good God, all the disclosures that are required. But as an example, I guess, Cody, like when I look at my experience in real estate investing, if I invest in an asset that is $500,000 or $600,000 and I put 20% down, so I'm putting down 100,000. Let's just use easy numbers. $500,000 house, I put down $100,000 of my own capital. I go and improve the place and make sure it's rent worthy. So maybe I put another 40, 50 in. I'm $150,000 in. The best cash flow that I've ever gotten on an investment like that was maybe $500 to $700 a month. And so I'm $150,000 in and I'm getting $700 a month in cash flow. And it's relatively illiquid. Like I could sell it, but to your point, I would incur capital gains taxes. I would incur land transfer tax. I would have legal fees. I would have your realtor commissions, things like that, right? Which would all deduct from my profit. So I guess I'd love an idea of like what sort of investment you'd be looking at and what sort of cash flow that nets you. Because if $700 over 150,000, let's just look at that real quick. It's like
That's about
less
point
than,
4, 0.5%.
yeah, point,
0.5%
it's
is
zero
good
zero
amount.
four, right? So
Yeah.
like that's not a great return. Well, and annualized, it's I guess a little bit better, but like it's not ideal, right? So
Mm-hmm.
we're looking at $8,400 a year over
About
150.
5.6%.
So
5.6% per year.
6%,
Yeah.
let's call it.
Yeah.
So
Yeah.
what are we looking at in the options world where I have more access to liquidity, right? I can make smaller
Yeah.
investments and actually get into it. It's more portable in that I can liquidate at any point on my phone. There's a lot of pros I can see already, but what's the cash flow like? Let's start with that, and then let's talk about how we can beat the actual S&P 500 without just holding it.
Yeah. So to answer that question, everyone is like, Cody, it's impossible to beat the S&P 500 in the long run. There's only 5% people in the world has done it. Warren Buffett's
Yeah.
one of it, right? For the last 50 years, doubling or tripling it, right? On every year, not every year basis, but annualize it. Yes, he's been beating it, right? And he has a lot of inside information, right? So that's why he said, people doesn't know anything, go S&P 500. Now, to beat it like that, it's not like every year, if the market's down, I'm down less, where I'm actually positive, I'm considered that as a win. It's still a beat. You know what I mean? And how do we do that then? It's not just, if I just go invest in S&P 500, that means I'm just riding along with the market. But it's a little bit more than that, because now you're going to introduce a concept, what I use, or I think I invented, called fast money, medium money, and slow money. We have the same thing in real estate. Fast money could be wholesaling, flipping. Medium money could be burying, turning into a duplex, triplex, adding value, whatever, then refi at the end, hope that it's stabilized. Or you could just be, you know what, I'm just going to buy a A-class asset and leave it there in 10 years. I know every year it's not going to look nice. I paid the top dollar, but it's buy and hold anyway. So in real estate, there's fast, medium, and slow money. And in stock option, we deploy the same concept, fast, medium, and slow money. Fast money will be our said and done strategy. I'm going to sell options on the S&P 500, and I turn that money around, turn the capital around every 5 days to 45 days. That's our fast money. That's where our cash flow comes from. Now, the downside of that fast money is if the market continues to go up, like what we have for the last few years, right? We might actually be making less money than the market itself. It's like all the wholesalers or all the flippers, while the market kept going up, they look at the number and be like, Cody, I might as well just hold every single property. I make double or triple the money, right? You hear the same
Yep.
statement. And that's the same downfall for our fast money. But in the regular market, if the market is flat, you still need that cash flow to survive. So you can't say, oh, I want to win in every single situation. So the fast money will work well, and the flat or slightly up market or even a slightly down market will make money. And that proceeds can go to for our medium speed money. That's where I can say, you know what, there's individual ETF or stocks I really like to own, but I want to utilize the stock option strategy of owning them at a cheaper price. So I sell options on them, agree to own them at a cheaper price, and I get paid premiums on it, and I further lower the cost average, right? But it might take longer. What if I own the stock now and it's dropped for a period of time, right? I can't make much money on it besides dividend. So that's where kind of like a burr, right? People get catching the burr, like, oh, the property, oh, we open the wall, we found more problem. Okay, now we're further out. Our cash flow is lower now. Sorry, investor, I might need more money. Things like that. That's a medium speed money, right? Now, the slow buy and hold is where we take these proceeds from fast and medium money and say, hey, this is where we're just going to go buy stocks, mutual funds, with ETF outright. And that's when we can capitalize on the speed and appreciation of the market. If the market kept going up like this, the fast and medium money cannot cash those because we are doing active transactions on it. But if you just buy and hold, right? You buy Apple for $100, it went up to 150, right? My fast and medium speed money might only make $20, 20% on them. Meanwhile, my buy and hold now make 50%, right? So there's always a balance of it. It's not like all will work at once, but usually there's at least two strategy. Fast or medium is working, or medium or slow is working. The fast is lagging, but we always have money making. And that's what gives me a peace of mind, right? So I have that in real estate. Well, I don't do wholesaling or flipping anymore, but I buy and hold. But the stock option really give me that fast, medium, and slow money. So the fast money is where I go and spend and maintain my lifestyle. Medium money is I keep building wealth. And then the slow money, just I look at my TFSA, RSP just kept going up. I'm like, okay, it's good to know that my nest egg are continue to go up, right? So I hope that
Yep.
answers the question of the entire concept of it.
Yeah, for sure. And I think that's a great way to put it as well, because it's very understandable, I think, for us as real estate investors to look at the various strategies and understand what sort of risk we're taking with a fast strategy, value-added strategies like like what you're calling a medium paced, and then
Mm-hmm.
your A-level stuff, right? Like there always will be A-level stuff. And I think
Mm-hmm.
like it makes a lot of sense at various stages of investment and at various stages of your investment journey to diversify into those different strategies, right? Like these days, I do very little fast strategy in real estate because I don't I don't have the same risk appetite that I did when I started, because I needed to like double the money that I had in order to have any money to be able to buy medium stuff. And so I think there's a natural sort of progression for real estate investors to start out with really risky investments. Like you buy that like brutal duplex, right? And you fix it up and you turn it over and maybe buy a few of those before you start getting into more stable fourplexes, and then six, and then bigger is a typical sort of investment journey for a real estate investor. Would you say that's the same, or people should approach this similarly, where if your risk appetite is high, you should focus more on the actual fast pace, like turnover with the options and things like that. And then as you
Yeah.
progress into having more of a portfolio and more of you have more capital essentially, is it natural for people to move away from those and into more long-term holdings?
Yeah, it's such a good question. And when I look at that, I look at it from two perspectives. How much of the gain was based on luck?
Sure.
When a lot of us started real estate, right? How much was that is actually we doing the right thing, keeping the cost down, and then adding value? Or how much is that is actually the market doing its thing, and we were safe by the market, right? If we had this Canadian real estate channel starting today, and then a lot of people go out and take a lot of risks, they might be upside down and might be in big trouble. But a lot of them are upside down, but they're not in so much pain because they built so much equity and they felt safe that way. Yes, we're some negative cash flow, but we can fill the hole and all that, right? At least that's half of the people I talk to in the real estate world, right? But in terms of stock option, most people start in Cody. I just have some TFSA, RSP. I put in some segregated funds. My company put in. I don't know what that is, but hey, the return's only 2%, 5%. How can I get more? They're like, okay, they start picking some individual stocks, and like some goes up, some goes down. Or for my case, like 5 stocks I pick, 4 of them goes up, 1 goes down. That 1 goes down might wash up a lot of the return, right? And that's why we go to S&P 500. But I'll say a lot of people, they start boring, right? If the market goes up, they're like, I'm genius. But when the market is flat, and I think it's going to be continuing more flat because of a lot of people, like there's no more middle class, right? So the middle class either become richer or become poorer, but there's less middle class. So I think the asset price will continue to go up, but less affordable for a lot of people. So I think the market will not move as fast as before in this case, right? So if you just buy and hold, you might not, you're just hoping for the market to go up, but you don't really make active money to survive and all that stuff. So I would say a lot of people will start investing passively in stocks, get into some options, and now when they get a little bit ideas, it's like, Cody, how can I increase more return, have more understanding? I know I might be taking a little bit more risk because of the market volatility, but I want to learn the right way to do it. So I don't have to sit in front of my computer 8 hours per day. Eventually, like myself, I only spent 30 minutes per week managing my $1.6 million account. But I didn't get there in the first day. Now I have a team of 10 right? They're reading the news, they're doing all that, right? We're going to start our hedge fund soon, right? That's what I'm preparing for. But not everyone has those kind of resource. So if someone's like, Cody, I want to do your same said and done strategy and all that, yeah, I mean, if you don't have the support, might not be as successful, but doesn't mean you cannot do it, or at least do the more basic thing. Invest in an S&P 500 and just go earn some, go own some good, individual stocks and go from there. But just knowing that you're not going to have a lot of active income, but you're going to have the equity built and maybe the value added things that you're doing, right? By not so much of a replacing a full-time income. This is what most people say, right? Oh, I come into real estate trying to replace my full-time income. But where's ever most of those people? I don't know. All my properties, all my money, I never took out a bunch. Every time a tenant turnover, somehow the money go up to 30,000, come back to 50,000, up to 30,000. I always lease 30,000. So I don't really have cash flow, even though it seems that on paper mortgages says, and I'm like almost doubling it. I still don't have much cash flow because I have property management, I have turnover, I have maintenance, and all. Unless you're a slumlord, right? But I'm not. So
Yeah.
that's how I'm kind of seeing it from years of experience in both worlds, right?
Yeah, no, that totally makes sense. Like it really is hard to hold on to your cash flow with an asset so capital intensive as real estate investing. And I talk about this a lot because I think cash flow is a necessity because not to replace your income, but because those future expenses are going to come up, whether that's capital expenditures like roofs, structural things like that, or it's more day-to-day stuff like you mentioned already, kind of plumbing issues and things like that that just come up in a day-to-day operation, or even just like lawn management, snow management, things like that. Like those all cost money. And I think that's where cash flow can at least eliminate or smooth that process for you. But I don't think people should bank on retiring from the cash flow on their real estate unless you're looking at like somehow owning all the assets outright, which is, I guess, a potential like 30-year plan. But it certainly doesn't work in the 1-3-5 rule, right? If we're looking at 1
No.
year, 3 years, 5 years, there's no way that's even a good deployment of capital. Even if you could do it, you probably shouldn't put all your capital into one thing that's paid off. So, yeah, I mean, I totally understand that. It's really hard to hold on to cash flow. So I think I've got time here for one last question. And I guess I just want to understand, like, how repeatable is this process? And I know we have another video coming up next week where we get to shoot and we're going to talk about S&P 500 and sort of you said 18 largest companies from the 80s?
Yeah, 20 largest company from
20.
the 1989 compared to 2021. We're gonna have that very interesting slides coming up to show you guys and let you guys guess how many of those were still there in the top 20, right? And
Yeah.
might shock you guys a lot, right?
I already kind of have an idea that it's not many, if any. So I'm really interested in that discussion. But before we leave today, I want an idea of like repeatability, because one thing I know real estate investors love is that control piece, because it's repeatable, right? Like we know the strategic investments that we can make. Like we know that if you change the flooring and the paint in a building, like you've made a markable difference in what people will rent it for at the very least. Maybe it won't sell for a ton more, but we know we can rent it for more. So we know that if we do that every time in every building we buy, we're always increasing the rentability of the property and therefore technically the value and profit. So with your strategy, how repeatable is it? And I know you've been doing this for a number of years now, and you've shown honestly that it can be repeatable just by growing your portfolio that much. But I would just love to hear your commentary on that. Like, do you believe that it's going to continue to be repeatable regardless of market conditions, regardless of political atmosphere and things like that? Like, is this a repeatable thing where I know every time I do these certain steps and I should, not always, but I should get this specific result?
Such a good question. Repeatability. Humans don't want change. Humans want consistency. And
Yeah.
that's what we strive for. That's why my entire team's goal is take away risk, not adding more return. If we can take away risk, our return will just normally, consequently become more consistent. So I don't look at how do we increase return. My whole philosophy morale for the team is how do we eliminate risk? okay, no more individual stocks. Don't be too aggressive. If COVID happened again, can we be the last one standing? That's always what I look at. And now I learned it from all these successful investors like Warren Buffett with like these big funds. I want to say BlackRock. BlackRock, I don't know if they're actually making money. We're just an AUM monster now. But like small to medium sized funds that actually make money. What do? They always look at it and say, what's my biggest risk? Right? So we try to take away those risks. So being very frank with you, right? Based on the fast, medium, and slow money, the slow money, if we just invest in the S&P 500, we're tracking the market. We're at least on par with the market. And there's some dividend on top of that, right? Now, the medium-sized money, right? Medium speed money, where we sell options on the S&P 500, trying to own S&P 500, it could be based on volatility. So when people are more greedy, okay, let's put it this way. Not when people are more greedy, when there's more uncertainty in the market. That's, for example, when there's an election coming up, when the COVID is happening, the same strategy was making 4 to 10 times the money during those periods. Why? As I imagine, if there's a tornado outside and you try to sell a home insurance, guess what? You can probably get a lot more money, right? People will be like,
sure.
oh, there's a tornado, I will pay for it, right? People pay
Yeah.
10x, right? But then that event doesn't happen many times, maybe a few times throughout the year. So those months will make more money, and you have to capitalize on it, and knowing to be on the contrary and be like, everyone's fearful, nothing changed, it's still the same in the long term, I will take the risk, right? But a lot of people might not be able to do that. It's like right now is a buyer's market. I'm shopping right now, right? I have a lot of cash. I'm like, I can shop, I can negotiate all day in real estate, right? But this is the time to buy. But most people say, oh no, Cody, I'll be sitting on the sideline, wait for it, right? Then you miss out. You might as well just put your money in the buy and hold. Then you don't have to make the wrong decision. But if you're someone who's smarter on the contrarian side, understand what's really going on and take advantage of the opportunity. Slow money, just on par with market. Medium money, you can make more, and said and done. Based on our analysis on where the market is going and all that, we can potentially, right, continue to beat the market. The only biggest fear, I'm full transparent, the biggest fear is when the market moves too fast in one direction. Because when it moves too fast, for example, if you're flipping, the market moves too fast and you're in this shorter turn of capital
Yep.
turnover, that's when you can get stretched a little bit. So that's why the capital size, I put 1/3, 1/3, 1/3. When something stopped working, other stuff is still working, right?
Yep.
And those are the fast money is where there's a little bit more risk, a little bit more active, but at the same time, if you know what you're doing, have a tight team, have a tight process, yes, you can definitely make more money. But there's definitely more things that you have to know about it, because it's not the market is fair, right? If everyone knows about it, and why not everyone do it, right? There's definitely a fair point to that. But if you have the right support system, you know what you're doing, the right learning strategy. But most people just like, Cody, I heard this YouTube video. Now I'm gonna go do on my own. I just had a call yesterday with someone, and they're like, yeah, Cody, I think I know what you're doing. I'm like, dude, what's your account look like? He's like, well, I've been losing money for the last 5 years. I'm like, so what do you think is different? He's like, Cody, I think I'm gonna try harder. I think I just need to take profit earlier, or maybe take loss earlier. I'm like, do you really think that's the only thing? Is that telling someone who's a flipper is that, oh yeah, you just have to buy better? Okay, sure. That's the only thing. Then the sky will be blue every day, right? So it's not sunshine and rainbow, but there's definitely more ways and ways that you can make it more consistent. But nothing is perfect. There's no perfect strategy, even in real estate or anywhere in the world, right? We just try to eliminate the risk so that what we've been left with is a higher return and more stability, right?
That's awesome. Yeah. And I appreciate that response and just your honesty on that too, that like, hey, there are some potential pitfalls too. Like if the market moves too fast, we incur more risk. And I know that every flipper watching this knows exactly what that means, because we know it. Like if the market's falling 10% a month and you're not selling your flip that's been listed for 30 days, you're probably going to drop another 15 at least right before you're done. And that's how you eat right into profits. So Cody, I really appreciate it, man. And thank you so much for coming onto the channel. I'm hoping that next week when we unpack more information about what's sort of been going on in the history of the market and how you've leveraged that knowledge to continue using your strategy with repeatability, that we get a better understanding even of how, as somebody like myself who doesn't have a great understanding of these things, like how I could invest 5,000, 10,000, 20,000 and watch it grow, or at least get a lesson out of it where I know I can get some more repeatability out of it in the future. And I think you made a great point there about working with a team or working with experts. We know this from real estate investing too. People will watch a video or they'll watch a podcast and then they think they're an expert at flipping homes. They go and flip a house, they make a bunch of mistakes, they don't control their costs, they have poor management, they make bad choices when it comes to the strategic renovations that they do. And, you know, they over renovate, or they don't do a great job at understanding the comparables in their market. And so there's no market for the thing that they've actually done. That happens all the time in real estate. So I really appreciate you saying, like, hey, even if you think you can go do this on your own at the start, it's probably best to work with somebody that has experience. And that's why we have you here on the channel today. It's because you've got a proven track record to actually do this over time. And I think that's really important for people to understand, is like, just getting some basic knowledge doesn't mean you're going to be great at implementation. So I appreciate you adding that in, because I think the people watching this need to understand, like, a little bit of information doesn't mean you're going to be an expert at doing any strategy, especially something as complicated or complex as stocks and options or real estate investing, right? It's not easy to just become an expert overnight. So I appreciate you bringing that up. And I know this has been a different topic for our channel, but I hope that if you're still sticking around here and watching this, you'll join us again next week when Cody and I have another fireside chat and we actually go deeper into the topics and uncover more about this strategy. So thanks again for coming on, Cody.
Oh yeah, and thanks for having me. And I think maybe it's worth mentioning, since I run a Facebook Live every Wednesday at 3 p.m. Eastern time, right? And I want to really extend that invitation for everyone else, because every week we talk about different topics, and most of them are real estate investor coming into stocks. We talk about stocks, we talk about stock options, what is fundamental analysis, technical analysis, what is buying options, selling option, what's market volatility, what's CPI, all that good stuff. And it's all free, right? So I have a Facebook group of more than 6,000 people now. And if people want to join that every Wednesday at 3 p.m. Eastern time, we can put the link in the description, and it's totally free. A Zoom, you can interact with me. It's about 40 minutes every week, and just learn from there and see if it's for you on that side of things, and go from there, right?
Awesome. Well, thank you so much, Cody. And we'll see you back here next week where we can learn more about how to say yay to fire.
Okay, let's do it. Say yay to fire.
Cheers, man.